Matt Orton joining in. He's, of course, from Raymond James and all the way from the US as well. And Matt, you just heard Priyanka talk about this, but I would love to know your view. The markets seem to be shrugging off any kind of potential economic impact or any other impact due to the shutdown. Are you in the same camp?
Hey, good morning, Niraj. It's always great to join. And I am in the same camp. I've been telling our clients to fade a lot of the noise that's occurring with respect to the government shutdown. When you look historically speaking at both protracted government shutdowns and very short-term government shutdowns, they tend not to have a material impact on the overall market. And we're seeing that play out right now because earnings are what drive the market going forward. And what happens on the federal level may have a very slight impact on maybe some defense contractors or some very small pockets of the overall market. But by and large, it's not derailing any of these long-term, durable, secular trades like we've talked about in the past, like artificial intelligence, that's really front and center with respect to all investors globally. So while no one likes to see the government shut down, it's incredibly frustrating as private citizens to see that you can hold the government hostage one way or the other. From a market perspective, I don't think it has that much impact. And so if you do see any downside, I think it's a great opportunity to use that opportunistically. So far, we haven't seen that play out yet.
Matt, thanks so much for joining us as always. About last year, I think, or maybe midway through last year in the Indian equity markets, there was this conversation about overvaluation in the broader markets because of the kind of money that was flowing into certain ideas. And we were talking about a dislocation. I'm just wondering whether a similar argument can be made about the artificial intelligence theme that you've just spoken about, because come what may, people are putting money into these themes, and you probably saw the valuation of OpenAI.
Yeah, absolutely. And I think that's a question, Alex, that a lot of investors and clients are asking. And I think they worry because the market continues to push to new all-time highs, really guided by this AI theme. The word bubble continues to come up. And I adamantly push back against that narrative. I do not think that there is a bubble with respect to artificial intelligence because we are seeing incredibly strong earnings growth tied to this theme. So a lot of companies, especially the hyperscaler and the biggest companies where you see market concentration, they're growing their earnings at double digits year over year over year. And so that's very different from what we've seen in the past. And the massive capital expenditures that they continue to increase. We're going to spend $380+ billion just in 2025 alone from 5 single hyperscalers. All of that money goes into the ecosystem, and that goes to the top and bottom line of a tremendous number of other companies who are tied to the AI theme, whether it's industrials, electric equipment companies, other semiconductors, software names. So there's a very large virtuous cycle to the AI trade, and I think there's still at least 18 to 24 months before you see CapEx slow down.
So Matt, morning, Hiral this side. Now, the shutdown is grabbing headlines. In spite of that, you're saying this is something which is behind us, not something that will impact markets. What are the other economic factors that could be pressing concerns that investors should watch out for? And would you be an investor at this point in time with the American markets, with the way valuations are panning out and everything in and around it?
Yeah, that's a great question as well. And I think, yes, I would still want to have a core overweight to U.S. markets. I think the dysfunction you see at the federal level, again, I still would argue it's a little bit more noise. But the flip side is, if this does continue for a longer period of time, I think the question does then go back to the Fed. With the lack of data that we're going to get, could that influence how the rate path is going to move going forward? And I think it's difficult right now for the Fed to change the course that it has set itself on, because Powell's trying to ratchet down tensions with Washington, D.C. And I think he was very clear in both Jackson Hole and the September FOMC meeting in basically saying that while inflation remains sticky, the potential left tail of a significant shock to the employment market is outweighing that right now. So given that you can still argue rates are not at neutral at this point, why take the risk when you see the reports like ADP we got earlier this week, where private payrolls are not great? Why take the risk and leave rates where they are risk another fight with Trump in Washington, D.C., as opposed to continuing on the 25 basis point cut in October and then December that's already impounded in the dots. And so I think we can have a little bit more confidence this time without, say, the non-farm payrolls, or if it's delayed, that we're likely going to continue to see that play out.
Yeah, a couple of economic indicators that one should be watching out for before taking that risk. Thank you, Matt, so much for joining us on the show.